And also with what's going on with commercial real estate, because not everybody's coming back to work now. There's over $1 trillion of loans that are coming due by the end of 2025. That's according to CNBC. I would just say that could be a time bomb for the economy as well.
And it was found that for years, Wells Fargo overcharged almost 11,000 investment advisory accounts, about $27 million total in fees. Wells Fargo agreed to pay a $35 million civil penalty to settle the matter without admitting or denying the SEC charges. Regulators said Wells Fargo failed to use compliance systems designed to ensure billing systems contained accurate data and didn't effectively monitor that the bank was not overcharging clients.
The reason we're sharing this is twofold. Number one is you really shouldn't be paying more in fees, and you need to inspect what you're expecting from a fee perspective. Next is if you're paying well over 1% in advisory and portfolio fees, and the banks do charge a significant amount of money or in a higher percentage on fees, why would you consider working with a private wealth management firm that charges less than 1% in advisory and portfolio fees together? Expense ratios with your 401k or traditional bank portfolio that's heavy in mutual funds, you're looking at a 0.7 to over 1% just in an expense ratio, plus a 1.25 to a 1.95. The average is usually around 1.5% in average annual portfolio and advisory fees the banks are charging in addition. So you could be paying upwards of 2.5% or more if you are with a bank. Just if you're trusting that big bank name, I would ask you to really reconsider, and we'll show you what it looks like when you make your portfolio more tax efficient, fee efficient, and market efficient, what could really happen. Also, what happens with a bond replacement strategy, where you've got interest rate risk and reinvestment risk with bonds. If you stay invested with a fixed index annuity, you can get some market-like gains without market risk. That's another one. And I just think you really need to worry about your income and also protecting your principal as well. You've got to be very careful and vigilant about what you're doing. A decade or more, they call it the lost decade from 2000 all the way to 2012. That is a huge loss of time. And for many people, it would be like over 40% of their retirement where they got zero gains from the year 2000 all the way to 2012. We can't afford to lose that kind of time with our retirement. We do need growth on our money so we don't just spend all our money. And so therefore our money can outlive us. It's a sequence of return risk is very important. And also implementing potential bond replacement strategies is another great way to go. So all you got to do is go ahead and reach out to us at 770-685-1777. Again, that number is 770-685-1777.